Good morning. Welcome to another What's Up with the Market session. We are going to do market status, but I'm just going to open up by further qualifying what I said in the last one of these I did a month ago on the 5th of February, 28 days hath February, and the talking a bit more about mechanical analysis. So, some of the discussions I've had with members is about this is very generic, the generic analysis, technical analysis that I go through. What's it got to do with us being mechanical traders? And so really what the answer to that was that I posed in the last session was that that these monthly updates, if you like, lead towards the 6 monthly update I do in the secular bull market. And that's really what we are trying to do here, is just have more regular, shorter term updates, but in line with seeing what's happening in the secular bull market, because picking a secular bull market, secular bear market starting mechanically is almost impossible to do. So we just keep our finger on the pulse a bit and then move into those 6 monthly updates and looking at the really big picture in the secular bull bear market cycle. But what I can do, what I'm going to start introducing now, is applying more of the mechanical systems that we have and applying that and combining it with the generic technical analysis. So you're going to see a bit more of a mechanical flavor in these sessions. And one of the ways that I do from time to time is you look to see what the signals are on the actual indices from a mechanical perspective, and there's some that are fired off overnight. And so that's one way of doing it. But another way of doing it is, and I've done this in the past many years ago, and I look at it from time to time, but I'm going to make that a more regular analysis, and that is using the mechanical system to measure sentiment. And so that's one feature I'm going to add today, and we'll talk about that at the appropriate time. And obviously I'll do the market status update. And excuse me, just a reminder that none of the analysis we do here is used in SPA3 investor or SPA3 trader. That's the generic analysis, but certainly the mechanical signals that I point out most certainly are. And also, I don't use any of this analysis to make any decisions in the public portfolios, the real money portfolios. They are run 100% mechanically according to the investment plans that we have published in the education center, and we follow those pretty strictly, and they are mechanical signals. And I don't use any of this in my own personal portfolios either. I'm 100% mechanical in my personal portfolios, and I've been a mechanical trader for years, or in fact you can measure that in decades now. So that is what I do, and I precisely follow our systems. I don't use any other mechanical systems outside of the ones that I use my real money with in the public portfolios and elsewhere. So this is to cover what we cover here today is generic investment advice. There's no personal investment advice in this, so it's all general investment advice. Right, let's move into the analysis of the Dow Jones. So what's happened in today's session in the Dow Jones is we've actually got an exit signal. Now that exit signal is a mechanical exit signal, so it's effectively using SPA3 Investor, and which has various levels of volatility. So it's an ATR trailing stop that we use here and breakout, but it's not just one parameter setting up and down for the ATR trailing stop. There's multiple parameter settings based on volatility levels. So there are sometimes as low as 6 and other times as many as 11 settings, depending on volatility of stock concerned. In the indices, there are very few levels. That's where the least levels are, because there's less volatility in index movement. So we have an exit signal here, and you can also see bottom right, although I haven't put the trend line on, but you can see the actual moving average, the green moving average rising here, is that there's been slight outperformance of the Dow Jones, made up of 30 constituents, against the S&P 500, which typically is a higher risk type environment from an analysis perspective. When you see the Dow Jones starting to outperform the S&P 500, then that typically starts moving towards a higher risk scenario that's potentially coming up. That's just one sentiment indication we can look at there. So certainly in the upper, let's just zooming out over here, we've got this long channel that's been going, which really starts back in 2020. So this is about a 5-year channel. Sorry, that's 2022. It's about a 3-year channel. And the Dow Jones is in the upper portion of that rising channel. And you can certainly see, might call that a double top. Certainly on a weekly chart, it would look like a double top. Right, onto the S&P 500, the same channel. So this is coming out of the end of 2022, and also in the upper half. And I've got this median line in the middle, roughly median in the middle of the channel, which is the S&P 500 sitting on that. And you can have a look at this on the Dow Jones in your own analysis, but we've got this retracement that started here. I've got this Fibonacci that runs all the way from back here in October 2023 to current, and it's still a shallow retracement. So there's the 23.6, and the Dow Jones is the same, and there's the 38.2. Any retracement, and all of the retracements on the way up over here have been shallow retracements around about that 23.6. If we start getting to 38.2, that's still normal. It's still not, it's not henny penny. The sky's going to fall on our head. And every now and then we do get a 38.2% retracement in a secular bull market. But this has been a primary bull market for some time. And I would say it's still a primary bull market just with a shallow retracement so far. The other thing to point out here on the S&P 500 is we've got a rising volatility. That red line is kind of a lower level. And I think 3.5, if you zoom out here, you'll see 3.5 is the upper level. And we still are well below that 3.5, but it is rising nonetheless. And you typically see that when the market has a retracement, but just something to keep an eye on. So we've got sell signal on the Dow Jones, sell signal on the S&P 500 as well. So things are looking a little bit shaky at the moment, as you would no doubt feel. And here the price action is matching all the rhetoric and noise that's happening around the joint. So looking here now at the breadth of market indicator, cumulative new high lows. We had divergence here leading up to that period. What is divergence? Making new highs, new tops, new peaks, but the cumulative new high, new low starting to fall. So that was divergence, and typically that does signal weakness. Not every time. But when there is weakness, you typically do see some divergence. And this is a cumulative advanced decline. Also divergence there as well, rising peaks, and the actual cumulative advanced decline line starting to fall, which means that there are more stocks declining, than those that are advancing or rising. Also had a breadth of market indicator here, number of stocks in the S&P 500 above the 150-day simple moving average. There are lower peaks, but on the breadth of market indicator, but higher peaks on the actual S&P 500. That's divergence, and we've seen some weakness in the number of stocks that are below their 150-day moving average, falling quite sharply there. So breadth of market starting to show some weakness as well. Another, now looking at a sentiment indicator, US dollar vs equities. And typically what you want to see here for strength is a falling US dollar, which leads to rising equity market, but we're seeing both falling at the moment. So, and that does happen from time to time, going in the same direction. Wherever I don't have a trend line here is where they're going in the same direction, not at the same rate, but in the same direction. The rate of change is we see in this relative strength line over here, and the steepness of that. And I've put a smooth index rate of change on that. And what we're seeing here is that the US dollar has been falling at a faster rate than what the markets have, and therefore that is positive for equities, and that is why we've got this green line here. So when the smooth indicator, the CIROC is falling, which is a CIROC, it's an indicator of an indicator, that's typically bullish, but we're not seeing that at the moment. So this is a sign, if you like, that there's confusion in the market when you start seeing some of these indicators getting out of sync from their typical behavior. And I think that's probably going to be the theme, if you like, of this session, is that there's confusion in the markets at the moment. and we all know why that's happening. It's people spoke about the Trump trade, and when the first presidency that he had, and now again, and there was this huge rush up in cryptos and equity markets. Well, this is also a Trump trade. But just not in the direction that everybody was hoping or expecting. That is in the up direction. It's in the down direction, and we know it's all to do with tariffs. And really nobody, you hear different commentators talking about it. Most of them are negative, but there are, there's nothing that's 100% negative in anything that happens, any variable. And there's there's nothing 100% positive in any variable that shapes markets, financial markets, societies, etc., etc. And right now, the negativity of the variable being tariffs is being focused on, and that's what's going to happen. But there will also be some positives. We don't know what they are, nor do we need to know what they are. But there'll be somebody will find something, and then the variable will change, as happens all the time in the cycles that run the market. So ours is not to reason why, as to what's going to happen in the future, and how the variable, how positive or negative a single variable is, and how all the other variables that are out there are going to react to that single variable. Because we just drive ourselves dilly. What we want to do is react to the price action and let the market, let the crowd, if you like, the sway of the crowd, which comes through the psychology of all of them combined into the price action to determine the price action, and then we follow the price action one way or the other. But just generically looking at the indicators that are coming out here, a falling US dollar would typically be positive for equity markets. Now we have to see which one gets the sway here. Is the US dollar going to strengthen? In which case, it's highly likely equity markets will continue to fall, or vice versa. Will the falling US dollar lead to equities rising again, and all the other variables that are partaking in this at the moment? So that's an interesting one. A little bit of confusion there. We're seeing a sellout of growth stocks. This is the Russell Growth Index. It's the ETF, which is an ETF of the Russell 100 Growth Index, and here we are seeing the growth index fall. And down the bottom here is the value index. It's kind of stabilizing, so you can see that the relative strength line is declining, and then we've got the smooth indicator over here of the relative strength line, and we've got a sell signal there. Pretty good sell signal if you're looking at it if you're using this as a timing mechanism. But I wouldn't just use it all on its own. But from a sentiment perspective, this is negative sentiment. So some more negative sentiment coming through these indicators. Right, the XLY, which is a consumer discretionary, another sentiment indicator where we measure the ratio between consumer discretionary and staples. Again, using the ETFs, the SPDR ETFs, which are obviously ETFs of sectors. And you can see discretionary falling. There's the sell signal. So that's a mechanical exit signal using SPDR Investor. And here we have the XLP, which is the consumer staple ETF. You can see it's rising. So quite plain to the naked eye, relative strength falling. And the Semiconductor, the smooth index rate of change, hasn't quite given an exit signal. But when it falls out of that blue zone, which is 90, that will be, and I say exit signal in inverted commas, but we'll put one of these red lines over there. But it looks certainly like that momentum is going to continue, and it might just take a day or two before that occurs. So consumer discretionary underperforming, consumer staple sentiment negative for equities there as well. The put call ratio that we have here is showing rising. So these lows, these higher lows over here, is showing that there are more puts than calls being taken out, and the 252-day moving average, annual moving average, hasn't quite turned up yet, but we're seeing a little tick up over here, and so that is not quite there yet. This is a longer term sentiment indicator, and so it doesn't get all those little squiggles that are seen on the put call ratio on the equities base, the S&P 500. That volatility smoothed out, and then we put a smooth index rate of change indicator on the moving average, the annual moving average of that too, so we don't get all the whipsaws. We try and make some sense of the noise. So quite hasn't turned up yet, but it looks like it's going to. Bit of a slow moving indicator there. Okay, turning to interest rates. So 10-year treasury yields, 10-year note yields falling, which would typically be positive for the market. But we can see that's why we've got this green line over here. So when this is falling positive, so that's typically a risk on environment, but we're seeing yields falling as well as seeing the market falling, another indication of some confusion. And we also are seeing, so because bonds are the opposite of yields, go in the opposite direction, we're seeing bonds rising, equities falling, and typically these should move in the same direction. But wherever I have trend lines over here is where they're going in opposite direction. So it does happen quite often, but in the short term we're looking at, that is negative for equities. We would expect to see equities rising in line with bonds and yields while yields are falling, but not happening. Again, confusion. Right, this is the VIX index. What I've put on here, which we haven't seen before for a while, is an average true range, 21-day average true range. Volatility, we call it, or price. It's a percentage of the movement. So the scale we see here is percent. Quite high volatility being the VIX index. And the barrier, that the upper and lower limits I've put on here would be kind of normal, but we're starting to see this rise now. So VIX rising, and this just puts a bit more order on the ups and downs of the VIX. And when we see this get above, I think I've got it 15 over there, that's when it's starting to get up to these higher limits over here. So the VIX is rising, which is also a negative for equities as well. So we're seeing lots of signs here, negative for equities. Right, this is the NASDAQ Composite. It went high risk, if you like, or gave a sell signal back here on the 31st of December. So the whole of this year, the NASDAQ Composite has been risk off, if you like. And you can see that the weakness there didn't fail to make new highs, a few attempts, and now it has got this retracement, fallen just below the 23.6. And so what I will do here is we'll add the 38.2 and that, keep an eye on that, which is one of the things that you should do over the coming month, is to keep an eye on how deep these retracements become before the market starts finding some stability, a base, and starting to form a trough. Right, so that's the Ciroc here, the smooth index rate of change of the relative strength has fallen below 90, which is also a risk-off environment. So we're seeing quite a few of these indicators aligning to be negative. And we're starting to see, we've had some sell signals. We haven't had a buy signal. I think we had one buy signal and a whole bunch of sell signals on SPA3 Investor for US equities for some time now, and we're not 100% invested there at the moment. And similar here with the SOX. Sorry, this is the NDX. This is the NASDAQ 100, so the larger cap, hasn't given an exit signal yet. And so just to go back to the NASDAQ Composite, where are we going? Wrong key. I'll just move this out the way. See, that is a green bar. So that was opened lower and finished higher. Same with the NASDAQ 100, opened lower, finished higher than the open. And so finished a little bit stronger. And I'll point out why I'm saying that in a moment, but hasn't given an exit signal yet. So here's one international index that's hanging in there. And I will put a Fibonacci on there the next time, but this is still less than a 23.6% retracement. So still shallow retracement at this stage. We don't know, every large retracement starts off with a small retracement, but we don't know how deep this is going to get, and nor should we try and predict into the future what that's going to be. So certainly hanging in there from a mechanical perspective. Looking at breadth of market indicators for the NASDAQ 100, there was also divergence here. This is the new high, new low. So more, so new highs were outstripping new lows, new peak over there. The new highs, new lows were the new lows were outstripping the new highs. We can see that by this declining line, but the actual index was still rising. So that's where the divergence comes. So, and whereas of the cumulative advanced decline, there was no divergence there to see. They were basically going in the same direction. Nor was the breadth of market indicator, the number of stocks above the 150-day moving average. We had, although the peaks stalled here, the actual number of stocks that were above the 150-day moving average continued to rise. So that might be divergence in the other way. It's a positive divergence almost. Okay, So let's just keep going on now, looking at the SOX. And the reason that I pointed out that both the NASDAQ Composite and 100 had green bars is that the SOX very much had now this is the semiconductor sector, which is a portion of the NASDAQ indices. It was the opposite. So the semiconductor sector has really been struggling for some time. We can see underperformance here against the NASDAQ 100. And this really is almost seen as a sentiment indicator or sentiment index in what's happening. So sentiment's been negative now for quite some time. But we have seen the indices go higher. We've seen our US portfolios go higher over the last 6 months. But there has still been a handbrake on the market. And eventually we need to see which way that wins out. Does the sentiment of some of the stocks, and they've not been the semiconductor or the tech stocks that have been taking our portfolios higher, it's been other stocks. Which one wins out? Does the negative sentiment on these tech stocks, which which are being the darlings, do they pull down the rest of the market, or does it happen the other way around, where eventually the tech stocks get oversold while the rest of the market is a large chunk of the rest of the market has been rising, and it then pulls up the tech stocks? And we're still in that phase. We don't know yet. We don't have a definitive answer on that yet. But these tech stocks are still underperforming the overall index. So that's the NASDAQ 100. So there's obviously other stocks in there that are doing better than what the SOX is. So the SOX is underperforming, which means the others are outperforming, because we have seen our portfolios go ahead. Our mechanical portfolios continue to rise. So, sorry, just one other thing to point out there before I move on. We haven't yet seen this rise over here, and we're not going to. That is way down. For this indicator to rise here, we need to see this relative strength line starting to rise, and it doesn't look like it's anywhere close to that. The moving average on the relative strength line is also declining, as are the trend lines that I've drawn on there. Right, moving to the Australian market, and this is where I'm going to sojourn into another chart before looking at the European markets. As exit signal occurred here as well. So of all the indices we've looked at so far, only one hasn't given an exit signal. That's the NASDAQ 100, whereas all the others have. We can see that the All Ords underperforming the S&P 500, which is typically a positive thing for equities, because when things get a bit negative and start going a bit pear-shaped, the lower volatility of the Australian market comes to the fore, and it relatively starts outperforming the S&P 500, although it's still going down, as it's going down by less. So we're starting to see a couple of signs of that over here. The moving average is starting to flatten out, but hasn't yet kind of broken out of that trend line yet. But still negative. We've got a sell signal on it, and SPA3 trader would now not be taking any new entries, whereas we continue to trade the SPA3 investor. Right, before I get into we'll do the US dollar, sorry, the AUD, the USD very quickly. In a downtrend, weakness still down in the low 60s. So no reversal here yet in this larger downtrend, which you can see in the black trend lines, which is the share price of Australia. So share price, as others see us from outside around the world, there is a weakness in the Australian view of Australia. Now I'm just going to click over to this chart. So I've been playing around with another sentiment indicator using a mechanical system to do so, and there's still some more refining I can do here. But effectively what this is, let's just make this a bit bigger. What I can do here is, what I have done here is I've basically run the top line here is the all ordinaries. There is an equity curve, which is a false equity curve really, because there's no compounding in it. But you run an all trades simulation in Beyond Charts, and effectively you get every single SPA3 trade that you can take that is sufficiently liquid, i.e. you're not looking at 2,200 stocks, you're looking at those that are liquid enough, which is why this the number, I'll explain to that in a moment, and you are taking exactly the same position size. So you're not taking bigger position sizes as time goes by, and you're running it as a static fixed position portfolio. And what that does, the equity curve is irrelevant. What is relevant is the number of open trades that we get and the percent invested that a all trades portfolio would run with. And what you get here, and effectively what this is it becomes a contrarian sentiment indicator, whereby on obviously a shorter term system like SPA 3 Trader, where the average hold period is about 6 to 7 weeks, you're getting shorter term trends. But what you're finding out is how many mechanical trades would be open at any given time. And obviously in a falling market, you're going to get relatively short-term exit signals without getting any entry signals. So you're going to have fewer trades open. And when the market's going gangbusters, you're going to get all these shorter-term entry signals. And then you're going to have more trades that are open. And we let it go to as many trades as the system can take. So we don't cut off trades because we run out of money. We just give it enough money to keep opening trades. And so then you can get the maximum number of trades that are open and obviously the minimum. And where things get to an oversold situation, theoretically what will happen is that's a contrarian indicator to say we could be finding a trough or a dip here. And that's effectively what's happened. Now I can zoom in here, which is what I'll do, but just from a big picture perspective, I've drawn these where the number of open trades is less than 10%. So this is, percent invested. So this is the amount of money is less than 10%. And we can refine this with different things, and I'm still working on it. But initial indication is that it's a pretty good contrarian indicator where we can, and more so to pick oversold situations than overbought, because obviously there's more upside but you can't go below zero, but you can add more trades as the market goes on. And there's also some survivorship bias in this, whereby the number of stocks that were available 15 years ago, particularly smaller cap stocks that were liquid enough, there are less of them than what there are now in the current database, because they have all got delisted, and then some of the new stocks have come along and got listed since then. So there's going to be less opportunity, if you like, the further back you go. So the absolute number of open trades doesn't really count that much, but what does is how many of those, from a percent perspective, are open that were available to be traded, and that's quite telling. And so what we're seeing here, and I'll just zoom in, going back to 2010, 11, 12 period, and I've just used the percent invested here, and every time we get below 10%, it's amazing how we find a trough, and there's always one or two trades open. But then we also get, and there's going to be some false signals, but you don't want to you could put some mechanical rules on this, but it's uncanny how the troughs are found when the number of open trades and percent invested of this portfolio gets really low. And you can see all these troughs, how they're aligned to the percent invested. So there's definitely sufficient evidence here by a mile for us to use this as a sentiment indicator, using a mechanical system as a sentiment indicator as a contrarian sentiment indicator to look for potential troughs. Now you can see there's a period here where there was the trough there. That's just a day or two apart. Sorry, there's the 10 there. And then the weakness continued. So there's no guarantee, because you find a trough and we get lower, you can see more trades came up, but those would have been, if you like, false short-term entry signals. But the eventual trough is only over here, but it's not that deep. It's not, the market doesn't move that far down. It's what you're doing is you trying to pick the bottom, but you're not trying to pick the bottom. You just want to find out and have an indication. We're looking at other sentiment indicators, so might as well add another sentiment indicator to our quiver and see if we can use that on an ongoing basis to say, are we oversold yet? So let's go all the way to the right. This is run up to today, and you can see we are not at an oversold. There's one place over there where we were oversold. I'll just put another vertical line where we just about got to 10. What did we get to? Nearly 10%, but that certainly does pick the trough pretty close, even though it got close to 10%. But we're up here in what I might term no man's land from a sentiment perspective, and so we're not totally oversold yet. So is there more dip to come? I don't know, but you would expect there to be. There's 121 open trades, and what this will do is it'll show you. Look down bottom left here, 120 open trades. and we don't quite know what the total universe is at any given time because we've got a minimum liquidity filter on that of trading an average of $50,000 a day on average, with I think no 0 days to if you like define our universe at any given time. So it's a variable moving universe. But so as of today, we can say that we are probably not at a trough. We would want to see more exit signals come out of SPA 3 trader and less entry signals happen for that to occur. And I think I ran this only back to 2009 because the further back you go, the less meaningful the data is, but also it takes a very long time to run. So we'll keep that one in, and for the next 2 sessions or so, I'll re-explain it. But then we'll just start using it as a sentiment indicator going forward and just be looking for these troughs. There's also some more work to do to see if the peaks are meaningful as well. But given the variable number of the variable size of the universe of trades, my initial looking at this didn't think it was as useful as looking at it from an oversold perspective and then taking a contrarian view from that perspective. So that is something interesting, and that's mechanical. That's something mechanical that I'm going to keep looking at in this session. Right, because we have gone into something new, I'm not going to go through. I'm going to whip through the other indices and look at just a couple of commodities, but I'll get through it pretty quickly. But there are some points to be made. The first one is that the Nikkei is also looking at, there was an exit signal in the Nikkei all the way back in July last year, and we've had this real confusion happening in the Nikkei where it's bouncing around its all-time high from back in 1989, and certainly weakness at the moment, underperforming the S&P 500. Right, the 2 markets that are standout surprises are Germany and the FTSE, the English, the UK, the index. And you can see here that the NASDAQ made an all-time high. Sorry, not the NASDAQ. The DAX made an all-time high. And sorry, I have to go to get that. Let's go to all data. The channel on the NASDAQ goes back quite some time, but you can see that it's still not near the top of this channel, this long-term channel on a log chart, but has got to a median line here. But the outperformance, all-time high and quite a steep, sharp trend over here. Some people might say that's in reaction to what's happening with tariffs and what's happening in Europe and Ukraine, all that. Well, that might be a variable, but this started some time ago. It started, in fact, this breakout over here occurred soon after the US presidential election, and the outperformance of the S&P 500 has been strong. There's been an election in Germany. There's a whole bunch of of unknowns and confusion and uncertainty going on economically and politically and everything in Germany. But the market's defying the negative noise and climbing that wall of worry and rising in absolute terms, but in relative terms against the US market. So that's one. The other is the FTSE also doing that. So the FTSE gave an entry signal. Let's just see where the NASDAQ gave an entry signal. Sorry, not the NASDAQ. The DAX gave an entry signal back here in August, and that's been a pretty strong trend. So here are worldwide, other world indices that haven't given exit signals. In fact, they're in pretty strong trends at the moment as things stand, and very shallow retracements. So we saw the exit signals in the US market, except the DAX. Now we're seeing these entry signals and these continuing trends in Europe, and that has been going since December 2023. So this is a 14-month open trade in the FTSE 100 and still going, and there's outperformance. So there's two. So again, adds to the confusion that's happening. Bovespa is indicative of emerging markets, most definitely in a downtrend, fallen back into the range again, and heading down. Gave an exit signal mechanically back here in September of last year. Right, quickly, the Chinese markets, the large cap. This is the FTSE China 50 made a new high over here, and that is pretty strange price action, but outperforming the US market. The broader Chinese market not as strong. There's that skyscraper and now indecision going sideways. And the South African market also outperforming the S&P 500, and we don't have any mechanical signals on it. But other markets around the world are not looking that bad. This is a resources-based market, as is Australia, and it's showing more strength than what Australia is. Very quickly on the commodities, we'll have a look at gold. Gold is nearing that 3,000 mark, found a bit of weakness right at that point. And I've got this shallow channel line over here, and it's fallen out of that. Gold beating equities. Silver, not as much strength as gold, but matching it. Copper getting to these all-time high prices again. So there's the all-time high. It snuck out above it, fell back into the range, tested it again, testing it yet again. And look at all those tests back here as well that failed. So a lot of tests. Obviously, copper much needed, and here it goes again to retest. So it's in this channel, and if copper, you get the feeling that if copper breaks out above this all-time high, which has been in place since 2011, some 14 years, that you might see a run-up like that. But anything can happen. Let's don't predict. Oil is already going sideways, finding this base at between $70 and $75 a barrel. And let's just quickly do the cryptos. Cryptos are down. So this is the Bitcoin US dollar price. It has found, it's certainly had some weakness, a bit of strength. Now, the last time we spoke about this, I said there was a bit of a rectangle forming here, which is a continuation pattern. And typically what had happened is that the price would continuation pattern, into the pattern from the price that was leading into the continuation pattern. But now this is turning into a bit of a top. Even though we've had a positive bar over here, that just might be a retesting of previous support, which has now become resistance. So the likely way, there's the exit signal, if you like, just on the using not 100% mechanical, but using the Siroc, which we do use in the mechanical system, SPA3 Trader. It's quite a good signal, quite a good pattern to follow mechanically, and does have an edge. The falling out below over here is this augurs for more weakness. So typically what would happen from here, falling out of the continuation pattern strongly, comes back up, tests. There's an oops where you have a higher open, and it closes down here, a retest of previous support, which has now become resistance. This should get weaker. So this is looking, obviously not 100% prediction of that happening, but typically that's what would happen with this pattern. So we should get some more weakness, and that's gone through in the alts and all the other crypto, but certainly in Ethereum, it's been pretty weak. There was the exit signal all the way back up here in December, and just following the indicator, the smooth index rate of change over here, you can see that weakness has continued down now to a support level. Will the support hold? We'll have to wait and see, but there's a lot of weakness in the crypto market. We've seen uranium fall through support, that support zone there, and we're gonna have to see where it gets to now. But it's certainly in this down channel, and we can match that. We can keep an eye on that. Iron ore has found support at these levels, so it's still meandering between 95 and 120. Whereas coal has fallen through its support. We were talking about there's a continuation pattern. Was it going to find a base? There's the direction coming into the continuation. This continuation pattern, this rectangle, if you like, fallen out the bottom. So it's continued from the direction that it started with. Right. Are there any questions? Yes, there is. Don saying, could you please have your analyses? I don't have my glasses. Posted on BC. They don't always seem to be. Okay, that's a good point, Don. I can do that. Yes, we've got new tools to do that, and you're quite correct. I've been forgetting to do that because that's in my hands now. Somebody else used to do the process, but we've updated the tool where I can just do it straight from my Beyond Charts, which I'll do as soon as I get back to my desk. And thanks for the reminder. I haven't been posting those. I can do those effectively daily now. It's up to me. So I'm the bottleneck there. Thanks for the reminder. Okay, so just to finish, we'll go back to the SPX and just say that there is confusion. And the main reason for me saying that is some of the indices are rising and are mechanical open trades on the indices, and some have given exit signals. And what I'll do is I'll just go to the US dollar. So S&P 500 is given an exit signal. And this is the one that is confusing the most, if you like, or giving the most confusing signals. Equities and US dollar going in the same direction. And they do that from time to time. And we just need to see which one wins out here. So thank you for your time. I'll end it there. And I wish you consistent and objective active investing if there are no more questions, which it doesn't look like there are. Until next, we'll be back in a couple of weeks' time, and we'll be looking at portfolio considerations where we are highly mechanical, and we'll start looking at a bit more depth of the actual indicator and why some of these actual signals do occur. So we'll be getting a little bit more, little bit deeper into the mechanical system and signals itself. Until then, we wish you consistent and objective active investing.